All right, no. So I know we've become accustomed to any down day being kind of like a really risk-off day, and are we? Is this the pullback? Is this the correction? Like, if we were to bounce back up tomorrow, is the correction now over with? That's not the case, and I'm going to show today's move in context of what we've seen so far, just to kind of really show the perspective of how a day like today is just practically nothing. There's up and down noise every single day. Obviously, more up than down lately, but there's going to be up and down noise every single day until we see something different. And today wasn't that case. That doesn't mean we can't take a look to see what's driving today. I'm going to show you the risk-off move that we've seen the past 4 weeks that's been hidden inside this really strong rally in the NASDAQ. I'm also going to show you a stock that itself has pulled, even though the market's kind of still really high off of its moving average. There's a lot of stocks, including this one that were for our trade the other day, where we actually pulled back and are showing a pretty good bullish bounce by the dip type pattern, and talk about how to trade that, especially in context of our posture on the broader market and how those two relate. So let's go ahead and get started. Today is Monday, April the 19th, 2021. This is the market outlook from marketscholars.com. My name is David Settle. All right, let's go ahead and take a look at the S&P 500 first with the market forecast indicator, as we always do. You can see how today's downward move looks like. I mean, a 0.5% drop is nothing compared to the window that it can trade within and still be considered a noisy move, right? It can drop all the way down to 39.62. That's a 5% drop plus, 5% plus drop from the high from the high point 41.91 down to that 39.62, and still be considered just a noisy move, right? And in fact, I mean, you would barely get below the moving average if we were to drop down there today. That's how significant. That's how high we are here and how bullish we are. You can see the near-term line's turned over. The near-term line's been above 50 now for 16 days. That's a really, really high, 7 to 12 is your normal time frame, so we're at 16. So I wouldn't put a lot of stock into this bullish intermediate confirmation signal. You can see we've had multiples here. We had one last week on Wednesday that we talked about, and that had a little 2-day rally. We had one over here that had a little bit of a 4-day rally or whatever, and then we had this one here, and that had a little 3-day rally. So we've had these intermediate confirmation signals where you get oversold momentum lines that aren't extreme, combined with a very strong bullish posture. The problem is, as we saw, here, it only lasted a couple of days before we're already back down because the near-term run is so long. And keep in mind, too, that the intermediate line run is still very, very long here. We're going on, we're over 5 months or 5.5 months now of this current intermediate run that we've been on. Remember, that ended on the NASDAQ. So the NASDAQ actually did end, and it's actually starting a new intermediate run that we're just a few weeks in, right? Because we started right here at the beginning of the month is when we turned up. We got the dark green shading there, and then a green line a couple days later. So, we are, 3 weeks now into this current intermediate run. And my thought on that one has been, because the others, the S&P did not start a pullback, my thought on this NASDAQ one is, the typical time frames of 1 to 3 months. I expected that we'd probably stay within that 1 month, closer to 1 month, because there still hasn't been an exhale on the S&P 500. You can see here's the current intermediate run Fibonacci lines, and here this would be 1 second here. 1 second, sorry. Okay. You can see here that, again, the decline we had today on the NASDAQ, again, coming out of options expiration, still hasn't even gotten to the 23% retracement level of this little short rally we've been on. So keep that in mind in terms of, when an intermediate pullback actually begins, even on the NASDAQ 100. Of course, the Russell 2000 still is just about as sideways as can be, and is back below its moving average. So you have a yellow line, a rising moving average that we're trading below, and you have light pink shading because the intermediate line's turned back down and it's still below its market sentiment line. So not really the most bullish there, and you can see the intermediate line can't really get above 60 anyway. Like, it's at the top end of being neutral. It's at, it's closer to 60 than it is being to 40, but it still can't quite get above 60, which is what would signify new bullish posture. I mean, you can see like when the Nasdaq got above 50 here and really kind of started the run, it got to 53 on that day. That's what got the dark green shading. That's what it went from 45 to 53, and then the next day it went from 53 to 62. So just like that, we went from being below 50, getting dark green shading, to being above 60 and basically starting this new intermediate rally. So the Russell 2000 hasn't done that, right? It's gotten up to this level. It got really, really close there at 59.5 and has been kind of stuck here while the market sentiment line continues to fall. So it kind of shows, the relative weakness that we're seeing in the Russell, which is a lot broader index than even the S&P 500 is right now, because it's so dominated by this literal handful of large cap tech names that's been driving a lot of this action here lately. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when our videos are posted when you're subscribed. Also, while you're down there, hit that thumbs up icon. That tells us two things. It lets us know that you liked our video, and also tells us that you want us to do another video tomorrow. It's a quick way to give us feedback. Of course, if you don't like our videos, you don't have to click on anything. But if you do, and you want to let us know, and we really appreciate it, you can do it with one click right now, even while you're watching. Just hit that thumbs up icon there. That goes a long way for us. Lets us know, again, like I said, that what we're doing here for free is something that you want us to keep doing. And you can just keep letting us know with one click on every video. As always, comment too down at the bottom on anything that stood out to you on what I discussed, whether it's a chart or anything that stood out or questions you may have. Post those in the comment section. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. You get access to our Market Outlook forum for free, among other things. You can be able to interact with other viewers of these videos on our website and our community. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there, at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're looking at, if you're watching our video here on our blog, come over here and check out our Market Outlook live video. Again, I post these every day. I do the Market Outlook. I do this video too at 3:30 Eastern time. You can just come right here or mouse over Market Outlook and click on Market Outlook Live Trade Review. That's what we do in those videos. We review all the existing trades we have from other market outlooks that we're still in. We also post today's trade already before the market closes, so that way you can kind of get into it before the next trading day. All of our paid subscribers get access to that Market Outlook Live, whether you're a monthly subscriber or our full premium subscribers. You also get access to all of our trading rooms. All of our paid subscribers get access to all of our trading rooms. Our premium subscribers, of course, get access to a lot more, including our communities associated with each class, as well as our premium tools. So check that out there. Come over here, hit this heart. It opens up a new tab. Hit that like button right there. Click on this thumbs up icon, opens up another new tab, and hit that like button right there. Again, the more you do that, it really helps us out, because Twitter and Facebook will promote our content that has more engagements to all of our followers that follow our accounts on these platforms. It also benefits you because they promote content in your timeline specifically from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here. All right, let's get back to the charts here. Let's take a look at the long-term chart. As you can see, again, another bullish candle, smaller body so far. It's only one day into the week, but another good bullish candle here on the S&P 500, another transition candle on the Russell. And you can see the Nasdaq also not quite getting up to a new high yet, and a much smaller body than what we've seen the last 2 weeks. So we'll see if these smaller bodies turn into something more. Remember, we're probably a few weeks away really from any significant intermediate exhale beginning, especially with how high. I mean, look how high that PPO is. It's still one of the highest PPOs the S&Ps has had outside of the late 90s in a long, long time. So very, very strong long-term momentum. From a 3 green arrow standpoint, we are still 3 green arrows, or we are losing momentum, and that's not surprising. Stochastics is still very strongly bullish, so it's not anywhere close to being bearish. There's your MACD histogram why it's falling, because we're so high. The MACD, there's not an actual limit, but there's an artificial limit as to how high the MACD goes, because it measures the gap between that 8 and the 17-day moving average. And the more parabolic you get, eventually, it's kind of hard to get too far away from the 8-day moving average, and that's what pulls it up above the 17-day. So that gap will probably start shrinking now that it's gotten as large as it has. Again, that's on an absolute basis. Here's that same gap on a relative basis here when you look at it down here at the bottom. And here, let's get rid of the actual MACD and just look at this one down here. Again, you can see, and I've shown you this last week, that it is still a very, very high. It's not as high as it was coming off the COVID low over here, but outside of that, it's still pretty darn high compared to where it's been in the last 10 years. So very strong move that we're getting. Of course, you can see it's showing up in a DMI ADX. It's finally up above 25. So very strong, kind of relatively parabolic move, considering what some of these other charts look like. The DMI got pretty darn high. The positive index, got pretty darn high. The negative index didn't quite get down there below that 10 mark, which is where you really get some significant bearishness. The IWM still shows more bearishness than bull. I mean, the positive index, the negative indicator has been above the positive for quite a while, and it's been above 25 for quite a while. So it kind of gives you a little bit of what the bias is right now on IWM. The Qs, you can see it's after getting that cluster on Friday is really kind of settling in here with that negative indicator getting back up above 20. So coming up away from oversold levels. So not quite as strongly bullish. You can see the RSI is coming back down below 70. That just again shows how strongly bullish we were, because it's very rare. As you can see on this chart, it's rare for the index to get above 70. This was a period where it got above 70. That started the pullback. This was another period it got above 70. It started that period of weakness that was as much of a pullback as we can get without actually being one. So here we are again, same thing with a bearish divergence showing up on the CCI indicator. You look at the SPY here, we are above 5 and above 80, so we have a strong bullish posture well up above the cloud, and the red line well up above the price. But again, you can kind of see there's a relatively artificial limits as to how far up we can get to these levels. Doesn't mean we have to drop, it just means it limits the momentum that we might have, at least in the short term, the intermediate term there. All right, so I mentioned to you before this rubber band that's been stretched out well beyond the 5% mark when you're bullish on SPY, but that just means that there's an opportunity for some downside here. And if you look at the Russell 2000 over the last little bit, in fact, if I go out to the 90-day mark here, you can see just how, here, let's go 1 hour. Will that get almost all of it in there? Let's go 2 hours. There we go. You can see there's not very much volume down below. We're very, very top heavy. Most of the volume for the Russell on the futures contract basis is actually up above where we're at right now. That's where the biggest volume node is, and it's actually where the point of control is, at the very top of this range. Not very much down here. So, again, breaking through this level, if I go back to the 4-week range here and look at IWM, breaking back down below this, will be relatively bearish. I mean, that will be a sign that we are, you can even see here on the 4-week chart, we have, in fact, the high is still on the left of the low point. Now, that's going to change tomorrow. The high is going to get over here, but it just kind of shows on an Arun basis, which graphically measures where the high and the lows are. The low's been above it this whole time, and we'll get a little bit of a break, but it won't jump all the way to 100, right? Which is like what happened on SPY. We did jump to 100. We actually never did cross below, and we stayed crossed below briefly here, but when it bounced back up, you see it bounce right back up to 100 and has pretty much stayed there with a slight little downturn. That's what it looks like on SPY, and the Qs also cross back up straight up to 100, but that's not going to happen on the Russell, right? When we cross up above, it's only going to cross up to right around this level, this 50 level. So again, shows how relatively non-bullish we are, and sets us up for the low to continue, the high to continue to push over to the front of that 4-day window, and set us up for easier for a new low to occur than a new high point to occur. Let's take a look at, we saw the volume. The volume is 78 million shares, just below the average. The trading range as well, just under 3 points. So when you look at those two numbers in context, 78 million is just barely below this falling average. And then the 3 points is just below the average too. And we're this flirting with being below 1. And we've seen this flirting before when we were pretty bullish going into September. So we'll see if that if we end up getting a fake out again below the 1% mark. Because normally breaking below 1% is very good. But when we're breaking below 1% on us when we're already within a 5.5 month long intermediate rally, that's a little different than breaking below 1% when you're just barely starting. When you're only say 1 month into an intermediate rally. So that kind of gives you an idea of where we're at there. And from a volatility standpoint, when we close so extremely low on Friday, obviously we bounce back up today, and that's not surprising. We almost always bounce back up on Mondays. But we didn't bounce up very much. We're still at we're in the lower half of this bearish territory for volatility. So we're still pretty darn bearish, which would be bullish for equities, right? The opposite. Keep in mind that, again, for an intermediate pullback to start, we have to jump up to 105%, and very rarely will we go from 80 to 105. Even within a day or two, it generally means that we'll kind of grind our way up to 90%, and maybe even break up to 95, and then we'll make that run to 105 from those levels, from low points that are around those levels, not from low points that are so extremely low. It just means that volatility right now is extremely low. It's very, very cheap, which is a good thing for people who are looking to potentially hedge this strong, mature, bullish trend that we've been on, and not just a mature intermediate trend, but also a mature market sentiment run, right? The market sentiment run we've been on since that COVID low point. We've been on here for quite a while. So here, let me go to a weekly chart to kind of give you an idea of where the market sentiment pullbacks are, where the intermediate line falls below. We've been on this one for quite a while now. We're not anywhere close, but it kind of shows us how the potential we have for more of a pullback that would get us down to this 38% mark on the orange line whenever we do get an exhale, more so than just a brief little pause. All right, so just to briefly summarize our technical outlook, obviously we're still very strongly bullish. This intermediate pullback is not going to be starting tomorrow or today with the still selling. We're still very, very high within that 0 to 23% retracement mark, even with today's selling. We have to get to the 23% mark before we get any kind of whisper of a pullback. That's how much noise there can be that we've already really seen in the S&P, where it's just been noise during periods where the NASDAQ actually has started a pullback and where the Russell came very close to starting one. The S&P has made some noisy moves, but nothing of an exhale so far, and we're still not very even close. But that doesn't mean that we've got a lot of upside from today, considering the maturity of the near-term run being 16 days, the intermediate run being 5.5 months, the market sentiment run being over a year. Those are all very long time frames for all those indicators on the market forecast. It doesn't mean we have to drop. It just means don't expect large returns from today going forward, and now trade accordingly, right? According to those expectations. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. Let me know why, or what you're looking at that tells you why you're either a lot more bullish than I am, or that you're a lot more bearish than I am. All right, now let's take a look. And I wanted to show you something here on this chart. This concept of this really high trend that actually peaked on Friday at 1.25. You can't really see that here, but it was on this day that we hit the highest level on the trend. We hit to 1.25. We pulled back a little bit today because the actually last couple of days but especially today because we had a 0.75 result on the trend. But let me show you what, because that's a 20-day trend that hit the 1.25. That's the highest level we've hit. We didn't even hit 1.25 on that peak or on this peak over here. We haven't hit 1.25 since the COVID drop, and we kind of hit it, came really darn close up in this area right there, hit just barely at 1.25. Let me give you an idea of what that looks like here on this asset allocation chart. So if I were to go to this comparison, and then let's go back 4 weeks from Friday. So we'll go all the way, that would be, let's see, 1, 2, 3, to the 22nd. And let's go like 15 minutes. Okay, so this is what it looks like, right? Bonds are up, commodities are up, bonds are up, and gold is up. The dollar is down slightly. Real estate is up. So very, very risk on. You can see developed markets, international, really outpacing small emerging markets. But look at small cap stocks. We're actually down during that 4-week period. Actually underperforming the dollar during that period, whereas QQQ was up 9%. So again, QQQ, remember, is very, very much dominated by a literal handful of companies. They make up 50%. Those FANG stocks, if you include Microsoft instead of Netflix there for the end, or Nvidia, that makes up 50% of the Qs of the Nasdaq 100. You add on Netflix and Nvidia and Tesla, and now we're even talking more, especially from an S&P. But it's very, very literal handful of companies that have really performed here. And so what does the trend look like? That it looks like a risk-off move. That it looks like the new risk-off move, where the Qs really kind of outpace more everything else, while the small cap index has been down. Well, in fact, was down the entire 4-week period. The Qs were up most of the 4-week period. The IWM was down the entire 4-week period. So, and just the gap keeps getting bigger and bigger. In fact, when you look at it over here, this is on the daily chart. You can see just how strong that daily move has been. Let me go back to just a 1-year chart right here, and you can see the big reversal we've had to get back above the 8-day and the 17-day, and we're just riding up. Very strong move here. In fact, it looks to me like it's actually setting up for an inverse head and shoulders pattern. If we get a period of weakness back to the 30-day moving average, don't be surprised that we don't get some kind of inverse head and shoulders and we really take back off. Again, my expectation is that we'll eventually work our way back up to above 2, right? So if I were to go back here to this predefined range and go all the way back to January of 2000, January the 1st of January 2000. So that's kind of where we started here. You can see we were up above 2 way over there on this level. We were well up above 2, and that's why I expect that we'll get up to on here. And it will form a bunch of divergences because I don't think we'll get up to a higher high on the PPO or on the MACD or on any of these other indicators. But I do think we'll get bullish enough and we'll kind of grind our way up enough. It won't be as parabolic as this move was. It'll be more grinding, probably take us through next year's midterm election time frame. So over a year and a half, about a year and a half for us to kind of grind up towards 2. And then that's ultimately, like we did in the late 90s, that's ultimately where we'll peak, I expect, on this particular indicator. But as of right now, you can see the big shift. I mean, this big outperformance on the Qs over IWM, that's what it took to go from a real strong bearish move that we've had to now, getting up above the 8-day in the last 6 weeks, getting above the 8-week exponential moving average, and now getting above the 17-week. We're still below the 30-week simple moving average, but we got a very strong MACD. PPO is turning up finally with a positive histogram. We're above 50 on the CCI. We're almost above 50 on the RSI. So we're working our way back into the upper half of the chart on these indicators where we spend, when you're bullish, that's where you spend most of the time on those. Quick look here at like the dollar, because that's been a big influencer lately and it's been sitting at a very important resistance level. Here it is today, really breaking out. So we've been kind of sitting at that resistance. the 23% level. Big time breakout move today. And this cluster is actually the current period that just started a couple of hours ago. So keep that in mind, that it doesn't end until tomorrow around this time. So that's actually tomorrow's candle that just barely started. This was today's candle that ended. So big time breakout move. So big drop on the dollar, big rally. We'll see if that ends up, you can see that gets back above the 23% level in this long-term move. We'll see if that ends up being the move that starts this bullish run on the euro, which was actually pretty bullish for risk appetite in general to get that start, or whether or not it'll be a fake out. To get a cluster, if that ends up holding, right, because it doesn't hold until the period's over, but to have a new bullish intermediate run starting with a cluster, it's a very good sign. The question is, does that mean that this new bullish intermediate run that's just barely starting on bonds that try to get above the 23% line but never did yet, is that going to fail, right? Or gold, is this new bullish intermediate run that it's had that did get above its 23% line but is kind of hitting resistance there, is this new one going to fail too? And so something's going to give there. Either these two nascent bullish runs on these other risk safe haven asset classes, either they're going to fail and we're back to risk on, or at least we're still on risk on for however many more months as we've been on the past 5.5, or that move on the euro is probably going to be the fake out and we'll break back down. So very important day in the next day or two, whether it's whether it's a 2-day candlestick pattern or an evening star candlestick pattern. But let's watch the next day or two to see if that breakout on the euro ends up being a fake out or not. Because if it ends up being a fake out and these two bullish runs hold, then there's your risk off pattern starting, right? Doesn't mean that we have to fall off a cliff, right? Just because I might say things are bearish doesn't mean that we have to just tank, right? That's for the media. That's what financial media wants you to believe, and that's just not the reality. The reality is, if it doesn't make us tank, at the very best, it slows us down. The strong bullish momentum we've had, it really slows us down. So what you don't want to do is chase returns in a grinding bull market, in a very mature bull market and grinding bull market, because it's not doing what it had been doing to get to this point. So you really start over leveraging to get the kind of returns that you have been getting the past few months, because that's just not the type of market we're in anymore. All right, so again, if I show you the sector comparison chart and they show you that same time frame, that same 4-week time frame, that they gave us that trend of 1.25, right, which is typically bearish, but obviously we haven't been bearish. We haven't been bearish here over the last 4 weeks. You can see the S&P is actually up 7%, but look at utilities and real estate outperforming the market during a really strong 7% run. It's utilities and real estate performing well, and you have XLK and XLY up there too. But again, it's kind of like, this is kind of a risk-off move. It looks like a risk-off move, but XLK has made it to where the market, and XLY to a smaller degree, has made it to where the market's actually bullish during this risk-off move here. So that's what a 1.25 trend looks like. It looks a lot more bullish than it actually is, or it is more. It looks more bullish than it actually is. It's not nearly as bullish as what you would think. If you take a look at the 12 grid here and you take a look at them on individual levels, you can look how high XLK and XLY are. They've made that strong run over the last 4 weeks. That's really kept the broader market bullish. But look at these safe haven asset classes too, and you see how bullish they are, and you think that's not typical during a bullish run to see those sectors really leading the charge, where some of these other cyclical sectors like financials and energy, which had been leading the charge, are really kind of rolling over and really showing a lot of relative weakness, XLC included in that as well. All right, so that brings us to our trade idea of the day. In this very strong technical sector, which is so bullish, not all the stocks look like this. In fact, some industries look like they're giving us a pretty decent bullish bounce signal. In fact, if you take a look at Marvell Technologies, it's had started a new intermediate run. It had an intermediate pullback. It started a new intermediate run. It's been pulling back so far on this intermediate run and is giving us a light pink shading and a yellow line pattern. Very good bullish bounce type pattern here, right at a 38% Fibonacci level. right at some volume support as well at the top end of this value area, as well as right at the Ichimoku cloud. After having broken up through the cloud here and now using the cloud and dipping below the blue line, giving us 3 red arrows. Right, these with just a small dip below the moving average. These are all in that light, and again that light pink shading and a yellow line. These are all very bullish bounce type patterns. I mean, either we roll over or we bounce back up. So some pattern like this here. We had a little pullback. We started a new run. During the beginning of the run, we have another little exhale, small exhale, near-term decline only that never really got extreme, and then boom, we bounce off of that. So this kind of rally is what I expect to come off of here. We'll see, again, without the broader market, without me expecting the broader market to be too bullish, that sets us up for not doing an extremely strong bullish trade. So I'll do a kind of a higher probability directional trade, and that's a bull put spread. So we'll sell that mid-30s delta, buy the 2 strikes away, trying to go for at least 47 cents. We're at 57 here, probably getting around 55. With earnings not until after May expiration, I can position size to a full position size here, and so that's what it looks like over here. Getting for a full position size, getting a little bit more return right now. Mainly because we've been pulling back to a low point. So if we bounce off of this, we might be able to get 50% of this return very quickly, which means we can be able to roll up our strikes and maybe get a 2-for-1 special, so to speak. We got 12 days that we can do that if we were to achieve 50% of maximum gain within the next 12 days. Once it gets inside of 20 days, then we'll just take, this will wait it out till expiration to get the full maximum gain. But if we can get the 50% of maximum gain early, then instead of just waiting with this trade to get the other 50%, I can roll the strikes up to a new trade and get a full maximum gain on top of the first half that we got on a stock that is indeed bouncing, because that's how you've achieved the 50% of your maximum gain. All right, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums on our website. Remember, all of our subscribers, including our free subscribers, get access to that forum. So let's open up any new thread, reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, as well as like us on Twitter and Facebook too, and then comment on our video. Have a great rest of your Monday night, everybody, and we'll see you all next time.